Silver just bounced 22% from $65 to $78 in 48 hours. Bitcoin back above $70,000. Risk assets added $1 trillion. But while you watch that bounce, a Chinese billionaire placed a $300 million bet that it's all a trap. His name is Beijing. This man made $3 billion from perfectly timed gold trades. He understands precious metals better than anyone alive on Earth. So when a proven gold bull suddenly bets against silver with the largest short in Shanghai history, you pay attention, or you lose. 450 tons of silver, 30,000 contracts, all positioned to profit when silver collapses. This wasn't casual, this was strategic. And it happened at the exact moment global inventories are draining faster than any time since the 1980s. That's not coincidence. Welcome to the hidden economy. If this deep analysis is what you've been searching for, hit that subscribe button right now. We don't chase headlines here. We decode moves that change everything. Drop silver shock in comments so I know you're paying attention. Let me start with the number that should make every silver holder sick. Shanghai silver is trading at $99 right now. Western price? $78. That's a $21 premium. $21 more in China than New York. That gap tells you what's really happening in physical markets. When physical demand is desperate, premiums explode. When supply is abundant, premiums disappear. So why bet on a crash at $21 premium? Because Beijing knows something about timing, about what happens when paper markets collide with physical reality. That collision is coming February 8th, 2026. Silver closed at $78 after the most violent week in modern commodity history. The pattern here is absolutely critical. Late January, silver hit $121 per ounce. Highest price in modern history. Higher than 1980, higher than 2011. Total breakout above resistance. Then came the crash. Not a pullback, not a correction. A catastrophic 35% collapse in 7 trading days. $121 to $65 in 1 week. $1.7 trillion wiped out across precious metals in 90 minutes on a single day. Traders holding leverage got liquidated instantly. Carnage. But here's what's strange. The crash stopped at $65. That level held. Within 48 hours, silver rocketed back to $78. A 22% bounce in 2 days. That's not normal market behavior. That's the signature of extreme intervention. Someone buying massive amounts at the bottom, or covering shorts. Now, UBS just published a report saying silver will hit $100 by March. That's less than 4 weeks away. They're calling for a 28% move in 1 month. But Beijing is betting the opposite direction with $300 million. Chinese billionaire with perfect track record betting on collapse. Major bank betting explosion. One of them is catastrophically wrong, and whoever's wrong will lose everything. At these volatility levels, there's no middle ground. Just winners. Let me show you why this matters beyond just silver prices. This is about the architecture of global commodity markets starting to break now. For decades, paper contracts and physical metal traded at roughly the same price. New York said $20. Shanghai agreed. The system worked fine. But that system is cracking. Paper silver in New York says $78. Physical silver in Shanghai says $9. That's a $21 gap. And it's widening. When paper and physical prices diverge, it means one of two things. Physical supply is so tight, buyers pay any premium to get real metal. Or paper markets are so manipulated that prices no longer reflect reality. In this case, it's both. Physical supply collapsing, paper weaponized. Here's the data point that should terrify anyone short silver right now. China's vaults have drained 90% since 2020. That's 600 tons gone. At the current drainage rate of 73 tons per day, Shanghai will be completely empty in 11 days. Less than 2 weeks until no silver left. And China is the world's largest consumer of silver. Solar panels, electronics, 5G infrastructure, everything. When vaults hit zero, they buy from West. That's why the premium exists. Chinese buyers know what's coming. They're paying $21 over spot because in 2 weeks, only availability matters. Now let's talk about what's happening on the other side of this trade. The COMEX in New York. The numbers there are even more insane. March. COMEX contracts represent 429 million ounces of silver. That's the amount traders are demanding for delivery. But here's the problem now. COMEX only has 103 million ounces in registered inventory, 429 million demand, 103 million supply. That's a 4-to-1 mismatch. We're 21 days away. If even 25% of those contracts stand for delivery, COMEX needs 107 million ounces, more than they have. If 50% stand, impossible. 70%, default. February deliveries saw a 98% delivery rate. That's unheard of. Normally less than 5% of contracts result in physical delivery, but not now. January saw 49 million ounces delivered. That's 7.27 times higher than all of 2024 combined. 7 times in 1 month. System breaking down. So here's the collision. Beijing betting paper prices crash because leverage flushes out. UBS betting physical demand drives prices to $100. Both could be right in sequence. Paper could crash, physical could explode. But timing determines who wins. One day early, you're bankrupt here. Now let me show you something that connects all of this to a much larger game. Something happened in Washington that changes everything now. 54 nations gathered for a meeting about critical minerals. J.D. Vance and Marco Rubio stood before representatives from 2/3 of global GDP. They said international commodity markets are failing because of forces outside individual nations' control. That's code for China manipulation. The President administration just announced a 3-weapon response. Higher price support mechanisms, increased Western production, export restrictions to China. 3 weapons aimed directly at breaking China's commodity dominance. And they're deploying all 3 simultaneously. That tells you the urgency. So now we have a new dimension. It's not just Beijing versus UBS. It's not just paper versus physical. It's China versus United States now. And silver is the battlefield. Because silver isn't optional. It's in everything. Solar panels, electronics, weapon systems, medical devices. Whoever controls silver controls the future of technology. That's why this $300 million bet matters. That's why the Shanghai premium matters. February 8th, 2026. We're standing at the intersection of the biggest commodity crisis in 50 years and the biggest geopolitical confrontation. They're watching Bitcoin bounce. They're watching stocks recover. They're reading headlines about market stabilization. Missing the real story. One side of this trade is going to win generational wealth. The other side is going to lose everything. And the next 3 weeks will determine which. There's a pattern in Beijing's trading history that reveals exactly what he sees that the rest of the market doesn't see right now. In 2019, he went long on gold at $1,400. 6 months later, gold hit $2,000. He made $800 million on that single trade. Pattern recognition. In 2022, he shorted copper at the peak. 3 months later, copper crashed 30%. Another $600 million. He sees structural breaks before they happen. But here's what's critical. He's not betting against physical silver demand. He's betting against the paper price, holding up under pressure now. That's a key distinction. Both things can be true simultaneously. Physical silver impossible to find. Paper price crashes. It's happened before here. March 2021 with gold. Physical premiums went to $100 over spot. But paper gold crashed from $1,700 to $1,450 in 2 weeks. Complete disconnect then. People who understood that made fortunes. They bought physical at crashed paper prices, then watched physical premiums explode as supply vanished everywhere. Beijing might be playing the same game now, short paper at $78, cover at $50 during panic, then buy physical at suppressed prices before reset happens. If that's his strategy, it's brilliant. The COMEX delivery crisis guarantees a reset is coming. The question is just timing and sequence of the events. Now let me show you why the COMEX situation is far worse than most people realize. The numbers I showed earlier were just the beginning here. COMEX registered inventory is 103 million ounces. But that's not really available inventory. That's just the number they report on paper officially. The actual deliverable silver that can be withdrawn and shipped within 48 hours is estimated at less than 40 million ounces. Maybe even less than that. Why the difference? Much of that registered silver is already spoken for. It's owned by entities that have no intention of selling at current price levels. It's sitting in COMEX vaults for storage, not for sale, but it gets counted in the official inventory number. So real available supply is much smaller. And here's where it gets problematic. COMEX has a history of changing rules when they're about to default on deliveries. They've done this before now. In 2021, they raised margin requirements overnight, forced liquidation of longs, crashed the price, then claimed no delivery problem because demand dropped. In 2022, they allowed cash settlement at exchange discretion, meaning they could just pay you dollars instead of delivering metal. Rule changes under stress, 21 days until March 1st notice day, for 429 million ounces of open interest, less than 40 million ounces of truly available metal. That math doesn't work here. So COMEX has 3 options. Option 1, somehow find 200 million ounces of silver in 3 weeks. Impossible. Not that much available anywhere in the world. Option 2, change the rules again, force cash settlement, raise margins, trigger forced liquidation, crash paper price and blame market forces. Very possible scenario. Option 3, default. Admit they cannot deliver. Lose all credibility. Destroy confidence in paper precious metals markets forever. Catastrophic, but possible now. Beijing is betting on option 2. He's betting COMEX will crash the paper price through rule changes before they admit complete failure to deliver metal. UBS is betting on option 3. They're betting the system breaks. Physical demand overwhelms paper manipulation. Price resets to reflect true scarcity at $100. Now here's why this matters beyond just silver. Silver isn't the only commodity where paper and physical prices are diverging badly right now today. Copper premiums in China at record highs. Nickel premiums spiking. Aluminum showing similar patterns. The entire industrial metals complex is fracturing right now. This suggests something systemic, not just silver manipulation, but the entire commodity pricing mechanism based on paper contracts is failing across the board here. For 50 years, we've priced commodities through futures exchanges. COMEX for metals, NYMEX for energy. Paper contracts set global price discovery mechanism historically. But that system only works if paper and physical stay connected. If futures contract for $78 silver actually gets you silver delivered for roughly $78. When that breaks, when physical trades at $99 and paper trades at $78, the futures exchange is no longer setting the real price. It's setting a total fiction. And if futures exchanges lose price discovery function, the entire global commodity trading system has to be rebuilt from scratch. That's not a small event. But the data doesn't lie here. Shanghai premium, $21. COMEX inventory crisis. Chinese vaults empty in 11 days. 98% delivery rate in February so far now. These are not normal market conditions. These are the conditions that precede system breaks. And Beijing has seen system breaks before. He knows the pattern. The question isn't whether silver is valuable. The question is whether COMEX can survive March deliveries without changing rules or defaulting on obligations completely. And if they do change rules, what happens to the legitimacy of commodity futures markets? Once trust is broken, physical premiums don't come back down ever. That's the trap. COMEX can win the battle by crashing paper prices, but they lose the war because physical demand accelerates at artificially low price levels. Every ounce delivered at $50 or $60 or $70 is an ounce that leaves the system forever, gone into products, into vaults, never coming back to exchanges. Beijing might profit from the paper crash. UBS might be early on the $100 call, but both know the same thing about the ultimate direction of silver. Silver is going higher, much higher, not because of speculation, but because the math of supply and demand no longer allows any other outcome long-term here. The only question is the path. Does it go straight up from here? Or does it crash first, then explode higher after COMEX plays its final card? February 8th, 2026. We're watching two of the smartest players make opposite bets on timing, but they're both betting on the same ultimate outcome ahead. Let me show you why the administration is moving so aggressively on critical minerals. They're reacting to something far more strategic than prices. China has been playing a 20-year game. We're watching the end game. In 2005, China began systematically buying mining companies worldwide for control. Lithium in Australia, cobalt in Congo, copper in Peru. By 2015, they controlled 40% of global critical mineral production outside China. Strategic accumulation. But here's what most missed. While buying mines, they built the world's refining and processing infrastructure at massive scale. That's the real choke point. Today, China processes 90% of rare earths, 70% of cobalt, 60% of lithium. Even if you mine elsewhere, it goes to China to be processed. They control it. That means China can cut off processed materials without touching mines. They control the choke point, not the source. The choke point is what matters most. They've been doing the same with silver, not through mining, through processing and futures markets to suppress Western prices while stockpiling physical metal. Here's the game. Keep paper prices low through massive shorts. Western miners can't profit. Projects don't get built. Meanwhile, China imports at suppressed prices. The West gets cheap silver on paper. China gets cheap silver in vaults. But when West needs physical metal, suddenly there's a $21 premium. The trap works. This is documented trade data. China net importer of silver every year since 2010, billions flowing in, and they've never reported strategic silver reserves, classified. When a nation classifies commodity reserves, it's because those reserves are strategic military assets, not inventory. Weapons. That tells you everything here. So when Vance stood before 54 nations talking about forces manipulating prices, he wasn't speculating, he was stating facts. Intelligence confirms it all. The West needs silver for defense systems, solar build-out, electric vehicles, AI infrastructure. All require massive silver, but West has no strategic stockpiles. U.S. Strategic Petroleum Reserve has oil. Strategic Helium Reserve has helium. Silver Reserve doesn't exist. China has massive unreported stockpiles. West has nothing. That's why the 54-nation coalition exists. Rebuilding Western supply chains before China's advantage becomes insurmountable. This is about survival, not trade. That's why they talk about price support. If silver stays at $78, Western mines don't open. If silver goes to $120, they become economically viable overnight. Higher prices hurt short-term. Inflation, manufacturing costs. But losing control of critical supply chains, that's an existential threat to national security forever. The calculation is clear. Accept higher commodity prices now, or accept Chinese dominance over 21st century physical infrastructure forever. Choice already made. Force prices higher, support Western mining, cut off Chinese access to materials, economic war through commodity control. That's the strategy being deployed now. That puts Beijing's $300 million bet into larger context. He's betting on U.S.-China commodity conflict outcomes. If U.S. succeeds, forcing prices higher, he loses. If China maintains control and suppresses prices, he wins. But even if his short profits in 30 days, his country loses if West rebuilds supply chains successfully. Chinese billionaire betting short-term paper crash, U.S. administration betting long-term supply chain restructuring. Both can be right. Question is just sequencing. Paper can crash in March, physical can explode in June, comics can change rules, Western mines can still open. All of these things can happen simultaneously. If Western nations rebuild mining capacity outside Chinese control, we're looking at complete reshaping of global commodity trade flows over next decade here. Mines opening in Nevada, Arizona, Idaho. Refineries in Texas, Wyoming. Processing in Canada, Australia. Parallel supply chain emerging outside Chinese control entirely. That takes 5 to 7 years, permitting. Construction, scaling, not fast. But once built, China loses choke point leverage they've held for 20 years straight now. That's the real bet. Not whether silver hits $100 next month, but whether West can rebuild strategic independence before next major geopolitical crisis hits us. Because next crisis will be decided by who controls physical resources. Not dollars, not technology, who has copper, lithium, silver. Physical materials matter. February 8th, 2026. We're not watching a commodity trade. We're watching opening moves of decade-long competition for control of physical industrial capacity. Beijing sees short-term volatility. Administration sees long-term structure. Both playing same game. Just on completely different time horizons right now. Now, let me bring this back to what it means for anyone watching this unfold in real time. Because the collision is coming faster than most people realize. We have 21 days until March 1st notice day on comics. 429 million ounces of demand. 40 million ounces of deliverable supply. That's a 10-to-1 mismatch right now. Chinese vaults draining 73 tons per day. At that rate, Shanghai is empty in 11 days. Less than 2 weeks until the largest silver consumer has zero vault inventory. UBS says silver hits $100 by end of March. Beijing has $300 million betting it crashes to $50. Both are positioned for extreme moves in opposite directions. The administration is coordinating 54 nations to rebuild supply chains and support higher prices. China is maintaining massive shorts and stockpiling physical metal. Every single piece is in position. The only question left is which domino falls first. Does comics change rules? Do Chinese vaults actually hit zero? Does U.S. strategy work? Here's what we know for certain. The paper and physical disconnect is widening. $21 premium in Shanghai. That gap has never closed peacefully in commodity history. The delivery rates are unprecedented. 98% in February. 49 million ounces in January. These are not normal market conditions. These are crisis-level stress indicators. The geopolitical dimension is now explicit. This isn't hidden anymore. 54 nations openly coordinating against Chinese commodity control. That's economic warfare declared. And the fundamental deficit remains unsolved. 5 straight years of consumption exceeding production. Every year the hole gets deeper, no new major supply coming online. So what happens next? Here are the scenarios. Scenario 1. COMEX changes rules in the next 2 weeks. Forces cash settlement. Crashes paper price to $50 or lower. Beijing covers his short. Makes hundreds of millions. Physical buyers flood in at suppressed prices. Chinese vaults get refilled. West loses another round. Possible. Scenario 2. COMEX doesn't change rules. Delivery demands overwhelm available supply. Exchange defaults or suspend silver trading. Paper market credibility destroyed forever. Physical premiums explode to $50, $100 over spot. Real price discovery moves to Shanghai and London physical markets. Western paper exchanges become irrelevant. Also possible. Scenario 3. Both happen in sequence. COMEX crashes paper first through rule changes, but physical demand at low prices overwhelms supply anyway. Then system breaks. That's actually the most likely scenario, because it's what happened in nickel in 2022. Exchange stopped trading, changed rules, but physical market kept going higher. In scenario 4, the long-term play. None of this matters in 5 years because Western mines open. Processing capacity gets built. China loses choke point control gradually. Silver trades at $150 or $200 because that's what it takes to incentivize new supply and reflect true scarcity. Both Beijing and UBS end up right, just different time frames. Here's what I keep coming back to. In March 2020, gold premiums hit $100. People who understood that bought physical at crashed paper prices. Those people won generationally. In 2022, nickel prices went insane. People who understood the supply crisis positioned correctly. Those people made life-changing returns before exchange suspended trading. We're watching the same pattern, paper and physical diverging, exchange under extreme stress, geopolitical forces fighting for control, fundamental deficit, getting worse daily. The question isn't whether this resolves. The question is whether you understand what's happening before the resolution occurs. Because after it happens, it's too late. February 8th, 2026. Silver at $78. Shanghai at $99. COMEX inventory at 40 million ounces deliverable. Chinese vaults 11 days from empty. 21 days until March deliveries. Beijing positioned for paper crash. UBS positioned for physical explosion. US administration positioned for long-term supply chain war. China positioned for continued control. Every player is positioned. Every piece is moving. The board is set. And in the next 30 days, we're going to find out who understood the game and who was just watching. This isn't financial advice. This is pattern recognition. This is understanding how commodity markets break when paper and physical diverge beyond a certain point. This is recognizing that when the world's smartest commodity traders are making opposite bets on timing, but agreeing on ultimate direction, something massive is coming. Study the data yourself. Shanghai premiums, COMEX inventory, Chinese vault drainage, February delivery rates, 54 nation coordination. It's all public information. Draw your own conclusions. Make your own decisions. But understand that moments like this don't come often. And when they do, they separate people who see from people who don't. Welcome to the hidden economy. If this analysis added value, you know what to do. And I'll see you in the next one, where we follow this to wherever it goes next.